This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Monday, December the 10th, 2012. I'm Gordon Long at GordonTLong.com. As usual, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly and leave you to examine all of them further at your leisure. You'll need to open your slide viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our quarterly cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers that are working behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and in the short term, confidence and sentiment. In this regard, I want to talk today about first, fundamentals and how earnings have peaked for this cycle. Secondly, risks that we see within all the economic indicators we follow as part of our global macro services. Thirdly, how confidence has diverged between business and the public, and the unusual combination of uncertainty and complacency that is evident and something we haven't seen other than in 1987 and in 2007, and I guess also I have to say in the fall of 1999 prior to the spring .com correction. I guess finally how we are clearly setting ourselves up for, and excuse my French, an oh shit moment after we complete the charade I will call the fiscal cliff discussions that are going on, and we effectively will kick the can down the road and what it will mean then. Going to our first chart. With third quarter earnings largely in the books, this chart provides some long-term perspective to the current earnings environment by focusing on the 12-month as reported S&P earnings. The chart illustrates how earnings declined over 92% from its Q3 2007 peak to Q1 2009 low, which brought inflation-adjusted earnings to near Great Depression lows. From its Q1 2009 low, S&P 500 earnings surged to levels that approached its credit bubble peak. Since Q4 2011, however, earnings have gone flat and have actually declined over the past 2 months. In the end, the latest data has inflation-adjusted earnings making new 13-month lows. I find these charts astounding. The latest Q3 GDP revisions show that corporate after-tax profits in the top left hit a brand new all-time high in the quarter. Another way to look at corporate profits is as a share of GDP, which is a pretty decent proxy for profit margins, shown in the top right. Once again, brand new high. On the bottom in blue, I show total wages as a share of GDP, which has fallen to a new low. Record profits clearly have been squeezed from labor. The question is how much is left to squeeze, with top-line sales now consistently flat to down. That was right across all of the Q3 earnings conference calls that I personally listened to. Stocks are overvalued, and market conditions have moved in a two-step sequence from overvalued, overbought, overbullish, rising yield conditions, and an army of other hostile indicators syndromes, to a breakdown in market internals and trend-following measures. Once in place, that sequence has generally produced very negative outcomes on average. In that context, even impressive surges in advances versus declines have not mitigated those outcomes on average, unless they occur after stocks have declined precipitously from their highs. Our estimates of prospective stock market return risk on a blended horizon from 2 weeks to 18 months remains among the most negative that we've observed in a century of market data. On the valuation front, Wall Street has been lulled into complacency by record profit margins born of extreme fiscal deficits and depressed savings rates. Profits as a share of GDP are presently about 70% of their historical norm, and profit margins have historically been highly sensitive to cyclical fluctuations. So the seemingly benign ratio of price to forward operating earnings is benign only because those forward operating earnings are far out of line with what could reasonably be expected on a sustained long-term basis. It's helpful to examine valuations that are based on fundamentals that don't fluctuate strongly in response to temporary ups and downs of the business cycle. This chart here on the top left compares historical price dividends, price revenue, price book, and Shiller PE, the S&P divided by the 10-year average of inflation-adjusted earnings. We go into that in a lot of detail in the technical analysis report in the full fundamental sections. To their respective historical norms prior to the late 1990s market bubble. A reading of 1.0 means that valuations are at their pre-bubble norm. Note that outside of the bubble era, major bull markets peaks tended to occur with valuations about 30 to 50% above the historical norm, while bear markets regularly brought valuations back to the historical norm and often well below that level. Secular lows generally occurred at valuations about half the historical norm. The 2000 market peak, which the S&P remains below more than 12 years later, reached valuation multiples more than 3 times the historical norm. Presently, on the basis of smooth fundamentals such as revenue, book values, dividends, and cyclically adjusted earnings, the S&P 500 is somewhere between 40 and 70% above pre-bubble valuation norms, depending on the measure. That's about the same point they reached at the beginning of this 1965-1982 secular bear period, as well as the 1987 peak. Stocks are far less overvalued than they were in the late 1990s, but it is worth noting that nearly 14 years of poor market returns have resulted simply from the retreat from those bubble valuations to the current rich valuations. If presently rich valuations were to retreat again to undervalued levels that have accompanied the start of secular bull markets, and see 1982, for example, stocks would produce yet another extended period of dismal returns. Presently, just 10 companies are accounting for 88% of all of the earnings growth in the S&P 500 this year. Apple, Bank of America, Microsoft, GE, and Google are forecasted to be 1/4 of the entire S&P earnings growth in 2013, with the top 10 names driving just 34% of the growth. Morgan Stanley's U.S. strategy or equity strategy team, which put this chart together, are calling for the S&P to end next year at 1434, basically flat. Downside potential is seen to be around 1135. Of the 20 firms expected to grow earnings faster in 2013 than 2012, 8 of them will be swinging from major slumps to miraculous gains. It seems that once the fiscal cliff is behind us, then the whole world is fixed, according to the analysts, and certainly those over at Morgan Stanley. And then equities can initiate a ramp mode, and analysts' expectations have a chance of coming true. This is just part of this complacency and false expectations that I've been talking about here for a number of months now. I've talked extensively in the written report and in previous audios about earnings decaying and falling off and continuously being brought down. And this chart just shows on the conclusion of Q3 exactly that continuing. And if we look at the earnings this year, it appears that this year looks to be a reward to those who stuck to normal investment allocations despite the macro issues in play and despite low global economic growth. That has got to change at some point here in the next quarter or so. With everyone well aware that revenues of S&P 500 companies have taken a turn for the worse and are declining for the second consecutive quarter, with well over a majority missing sell-side estimates and trimming Q4 guidance, many are wondering how can corporate earnings per share continue to grow even if nominally? Are there really so many people left to be laid off? The answer to the latter is no, for the simple reason that it is not layoffs that have driven the upward persistency in corporate earnings, surprisingly. Then what has? Simple. When in doubt, charge it. This axiom seems to work not only for cash-strapped consumers, but for corporations who know very well that when unable to satisfy earnings estimates using regular way earnings, companies can just write off one-time charges and get the going concern earnings per share benefit for such an action. In fact, as the table shown here, and I apologize for the detail, a whopping 14% of all pro forma 2012 earnings per share will be due to one-time write-offs, the highest proportion of total earnings since 2009. What is very clear is that of the 104 pro forma earnings per share, a whopping 14% of this, or 14.06, is in accounting one-time write-off fudges, which are merely creative accounting ways to get benefit for deteriorating operations and which never manifest in the form of actual earnings or cash flows. In other words, far from the touted adjusted earnings per share growth from 97.88 to 104 in 2012, which implies the S&P is, oh so cheap at 1400 or under a 14 times multiple. When one looks at the real earnings pre-write-offs, which are not and have never been earnings, but are merely an accounting gimmick used and abused by every company since time immemorial, the real earnings in 2012 will be $89 per share on the S&P 500, which in turn means that the implied forward PE multiple is roughly 16 times at the current market level, above historical average. It also means that in 2012, GAAP earnings per share will grow by a tiny 2.7%, the bulk of which can be attributed to financial firms' loan loss reserve releases, which is also a form of one-time earnings per share adjustments. Finally, and proving that real earnings per share trend is caught up with a decline in revenues is that Q4 GAAP earnings per share of 22 are going to be down from Q3's $23.29, dashing all hopes of a surge in Q4 earnings net of every GAAP fudge imaginable. And this is how companies perpetuate the myth that all is well on the bottom line, since top-line growth is now dead as the recent demise of Twinkies, and only endless recurring one-time adjustments are left. That's the game that's getting no press, and you need to understand. A shockingly low 30% of S&P 500 firms beat revenue expectations in the prior quarter, and while Bloomberg's data suggests about 65% beat earnings expectation, the in-period adjustment of expectations, analysts ratcheting down earnings as the season progresses, naturally biases this to look rosier. The critical question is, how much more fat is there to cut? With sales and outlook so weak, how many more jobs need to be cut to meet margin expectations, or accounting gimmicks can be found? 2013 top and bottom line, plus 13.6% earnings per share growth, expectations remain magnificent in their optimism. The question is, do you believe in miracles? Well, the miracle here, the Santa Claus miracle, is, I guess, the gift of giving, and that is the shadow banking system. And a recent report just put out by the Financial Stability Authority, part of the Bank of International Settlements in Basel, just showed for the very first time that the total global shadow banking system is now $67 trillion. $67 trillion. This is separate from the central banking system. But more importantly, and well, shocking as that, more importantly, it was up $6 trillion in 2011. So while we had a collapsing and deflationary move, $6 trillion was created magically somewhere. And that's money above and beyond the magnitude of money that's officially being printed by the central banks under quantitative easing unlimited, OMT uncapped, and soon to occur in Japan, where Japan is not even going to hide it after QE9 and zero interest rate policy for close to 15 years now. If Abe gets elected on December the 16th, he's going to QE Unlimited and NIRP. And NIRP stands for negative interest rate policy. So this will mean that the big controllers of the fiat world currency, that is the US, the EU, the Bank of England, and Japan, are flat out unlimited printing money in addition to the shadow banking system. So these are clearly tailwinds that are blowing strongly, but nevertheless artificially inflating this market. While all this sounds good and has been good for the equity markets for most of 2012, there is a dramatic change that's occurring in the yield market and in the bond market, and consequently as part of this whole financial repression as we're moving down towards probably 1% on the 10-year bond, is there is becoming a supply shortage in the bond market, if you can believe that. And it is forcing the pursuit of yields in a way we've never seen before. And clearly, if the bond yields move down closer to the 1%, as all indications are, this is money that's not going to be flowing into the equity markets. So as we get into Q1, Q2 of next year, this chase for yield is going to have an impact on the equity markets. We're already starting to see it, and you can see that this gap is going to have to be closed, especially if the red, in fact, actually heads lower. And as there's a shortage of all available supply, as shown in the bottom, of all various forms of debt notes. The money not chasing yield in this bond bubble is money that is being allocated to savings accounts. The more Bernanke's attempt to rekindle the animal spirit fails, the more it's going to cash. And while this cash is, at least on the surface, what is known as money on the sidelines, the flip side also is that should this money ever leave the sidelines, modestly at first, then all at once, then the Fed's moment of reckoning will come, as that will be the moment when the Fed's ability to keep inflation grounded in 15 minutes or less will be thoroughly tested. Paradoxically, Bernanke wants this money to re-enter the risk markets and or the economy, but not in the way that leads to hyperinflation. After all, there is $10 trillion in electronic money in the U.S. system and only $1 trillion in cold, hard cash available for cash claims satisfaction. All that brings us to weekly changes in the amount of cash held in savings deposits at commercial banks, as shown here. And the chart shows rapid, dramatic shifts characterized by massive inflows of cash into such savings accounts. Usually coincides with times of great monetary stress. The three biggest episodes in history to date have been the 2008 Lehman failure, the August 2011 debt ceiling crisis, and associated U.S. downgrade, and the May 2009 first Greek failure and bailout. Those episodes represent the biggest weekly savings deposit inflows, number 2 through number 4. When was the largest ever inflow into savings deposits at commercial banks? At $131.9 billion in 1 week, a few weeks ago. That's when. We don't know, but the people who control $5.6 trillion in U.S. commercial bank savings deposits, certainly not the vast majority of the U.S. population who have virtually no money saved up, but the true 1%, just decided to park the most cash on a week-over-week basis into their savings accounts in all history. Well, most of history, at least the short-term history. Perhaps we can ask them why they did it. They certainly aren't talking. Switching gears somewhat, as you glare hopefully at the critical 1400 level on the S&P 500, I thought a gentle reminder here of the vertically challenged relative performance of the economic fundamentals would be worthwhile. When it's unusually hard to tell where the economy and government policy are going, businesses will be reluctant to invest and hire. The notion isn't new. It was central to Federal Reserve Chairman Ben Bernanke's PhD dissertation in 1979, and I quote, "Increased uncertainty provides an incentive to defer investments in order to wait for new information." He wrote with a lot of equations. Mr. Bernanke argued that investing and hiring decisions are hard to reverse. When there is a lot of doubt, businesses wait. End of quote. But the possibility that uncertainty about government policies might make a weak economy worse is timely. There is growing angst among the U.S. fiscal cliff. The spending cuts and tax increases set for the beginning of January. There are signs that fears of going over the cliff are contributing to slower business investment and gloomy forecasts about fourth quarter growth. There are doubts about the longevity of the euro and whether European government can pay their debts. One, there is more uncertainty when the economy is bad because that is when governments are more likely to actually do something, for better or for worse. So that is when markets are particularly sensitive to clues in politicians rumbling. And two, stocks tend to move in unison when there is little clarity about government policy because it's hard for investors to discern which companies will be winners and which will be losers. As the chart on the right shows, this is the University of Michigan sentiment, the latest one out on confidence, and it has absolutely plummeted since the election. It is ripe for a Molotov cocktail and for something very, very ugly to quickly and suddenly erupt. I'm not saying imminently, but certainly in the not too distant future. I'm not trying to be negative here. I'm just trying to point out the facts continuously, the best I can of what I consistently see. This is the chart I'm showing here is from many I went through with the Nielsen's Worldwide Global Consumer Confidence Index. And what it shows is that the consumers around the world are cutting back. This is not good for profit growth. And you can see that the U.S., North America at the bottom is the worst. So that these are going to be tremendous pressures on corporate earnings. And corporations see this. They know what's going on. And I'm showing here the capital formation or capital expenditures, CapEx, whether in the big corporations, small companies, they're not spending. They have cut back and cut back dramatically. And if you're not increasing your spending in investment, that's not going to lead to job growth. And therein lies the fix that we're anticipating that's going to turn the economy around. We're not investing for this turnaround. And if you look at the volumes in the markets, the investors aren't there. What you have is nothing more than the algo traders consistently trading on the momentum, end of day spikes, etc. If you go to the demand for credit, which is the real engine of the markets, easy credit, you can see that even though money is available, the demand is falling off significantly, not just the CapEx, but also the investment monies. The broadest U.S. equity indices began to fall following the second presidential debate in mid-October and stabilized after the third debate. Weakness was well balanced with the most shorted names, staying in sync with the indices in a more systematic risk-off manner. Hurricane Sandy appears to be the beginning of traders pressing the most shorted names. We would suspect this was beta chasing on expectations of weakness. And then once the election results were known, the most shorted names that really outperformed, that is, they fell considerably more than the index. As the chart here shows, just as Washington's cone of silence began, the Russell 3000 had fallen 6% in November and 8% from the second debate, while the Russell 3000's most shorted index had dropped almost 10% for the month and 12% from the debate for a massive 400 basis points outperformance. The following 2 weeks led to where we are today. The most shorted index has been squeezed about 9.25% higher to catch up to the broad Russell 300 performance for the month. As the month closed, the index and its most shorted names were perfectly in sync and unchanged with one another, thus reducing dramatically the fast money ammunition for further squeeze potential. The Russell 3000 and the most shorted names have recoupled after a dramatic short chasing post-election. Some policymakers and commentators are attempting to make a molehill out of a mountain, seemingly less worried about the outcome of the negotiations in the short term, as they believe the cliff is not a cliff, but more of a slope, since the economic damage will initially be limited, while any equity market sell-off will only spur a resolution. We tend to side with Barclays and the Bank of America Merrill Lynch that the full set of expiring measures constitutes a cliff, not a slope. In brief, here's why. Automatic withholdings, and in Geithner's words, no authority to delay the process. The extent to which households can buffer this higher withholdings is significantly weak, as recent savings rates have plunged, implying a need to draw on liquid assets to smooth any consumption shortfall. You know, as Winston Churchill said, you can always count on Americans to do the right thing after they've tried everything else. You know, we remain stoic that stock market weakness and severe outside criticism will be important in forcing any agreement, as the politicians appear to face, 6 at least significant hurdles ahead. It seems to us we are following the same path as last year's debacle, and what we like to call, as shown on this chart at least, the 3 F's of fiscal policy in America. And as Barclays has put out and written, that given the tight legislative calendar and the two parties' gaping differences of opinion, that they see a strong possibility that policymakers will, in fact, go over the cliff, raising the questions about how quickly a resolution can be reached before serious damage is done to economic activity and financial markets. We see this all just leading to a lot of volatility as we go into probably the January options expiration, the third Friday of January, and possibly a little later into February, as we're putting in a long-term right shoulder. And as we've been showing for quite some time, not quite sure exactly what the final topping point would be. I think we now see it to be actually in. There is a chance we could get on a nominal basis a slightly higher high, but it appears to be in, and we've had this recent rally more associated with the further devaluation of the U.S. dollar, a little bit of fiscal cliff optimism here that we're going to possibly see some sort of resolution. That'll give us what I will refer to as coiling, and that is, from an Elliott wave standpoint, 1-2 waves, 1-2, smaller degrees, all part of this right shoulder before we start on a continuation of the secular bear market down. This chart here is showing that we actually have even a smaller degree head and shoulder building within this final wedge structure that is not really detectable in the previous chart on the longer term right shoulder that we were talking about. We obviously go into this in a lot more detail in the technical report with a lot more charts to give you more detail, and we encourage, for those who aren't already subscribers to our Trigger service, to be a subscriber, or to look at the trial, because we take the charts right down to hourly charts, and we publish charts Monday through Thursday during the course of every week. In closing, I'd like to take a moment as a reminder: do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2013 be an outstanding investment year for you, and I hope that 2012 has been a good year, and the best of the holiday season to everyone.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly.